If governments wiped out their debt tomorrow, don't expect lower loan rates instead. Your borrowing costs could skyrocket because a sudden reduction in debt could disrupt the entire pricing system that your bank depends on to set interest rates. This video answers one question: no tips, no recommendations, no predictions. If debt is bad, why do governments keep issuing it on purpose year after year, forever? The interest rates on your mortgage, car loan, and business credit are often based on government bond yields. A yield is the bond's implied interest rate, the going price of money over time. So the debt problem is actually the system's measuring stick for determining the value of money. That's the contradiction. The very thing you're warned to fear is actually what sets the rules. Once you grasp how it works, the term addicted starts to shift toward being dependent on the system. Government debt is mostly IOUs sold to investors through public auctions. In the US, they're treasuries. In the UK, they're gilts. Same idea, same role. You lend cash now, and the contract promises payments and repayment later. These contracts are standardized, allowing anyone to buy, sell, or trade them without the need for renegotiation. Standardized means the market can move fast without trusting strangers. Here's the first mechanism people miss. These IOUs expire on a schedule. A bond matures when its due date arrives, and the principal must be repaid. However, the system isn't designed for a zero debt day like you might see with a household paying off debt. Instead, maturing IOUs are typically replaced by new IOUs again and again. That replacement loop is called rollover, where new borrowing fills the gap left by maturing debt. Rollover isn't hidden. It's how a market built on maturity dates keeps running. The debt isn't just a single loan, it's more like a continuous conveyor belt of contracts. If you stop the belt suddenly, you don't just change budgets, you jam plumbing. So why does the plumbing want the belt to keep moving in the first place? The obvious answer is governments overspend, and deficits can matter. But that explains funding, not why markets treat these IOUs as core utilities. Because the system rewards assets that are liquid, comparable, and widely accepted. Liquid means you can sell fast near today's price, even in huge size. Comparable means contracts look alike, so prices can be compared instantly. Accepted means institutions can use them without arguing over what they are. This brings us to the first key point. Government bonds serve as the economy's yardstick. A yardstick is a reference that helps everyone price everything else consistently. Bond yields often become that reference because the market is deep and visible. Yield is the return you can expect based on the current price of the bond and the payments it promises to make over time. When yields change, the price of waiting changes across the economy. That's why rate headlines can show up in mortgage quotes and loan offers. Government debt is less about spending and more about pricing time. Without a shared time price, lenders widen spreads to protect against uncertainty, and wider spreads mean higher costs for households and firms, even in calm times. The yield curve is simply yields across maturities, short, medium, and long. Think of it as a menu: 3 months, 2 years, 10 years, and beyond. That menu helps banks set loan rates without inventing a new baseline daily. It also helps businesses decide what long-term money costs right now. And it helps investors compare returns without guessing what the ruler is. Now, job 2. These IOUs are also the system's preferred collateral. Collateral is an asset pledge, so a lender feels safer providing cash today. Modern finance borrows short-term cash constantly, even inside safe firms. Repo is an overnight cash loan backed by bonds, allowing cash to flow smoothly without triggering panic. One common channel is repo, short for repurchase agreement, which operates in money markets to facilitate short-term borrowing. Repo is a cash loan backed by bonds, often overnight, between institutions. You give a bond, receive cash, then buy the bond back later at a set price. This is how cash pressure moves through the pipes while markets stay liquid. Government bonds are favored here because they're standardized and widely traded. The debt isn't just a number, it's reusable collateral that powers funding. When collateral is plentiful and trusted, funding is smoother and cheaper. When collateral is scarce or questioned, funding becomes jumpy and expensive. That jumpiness can spill into credit conditions long before any crisis headline. Now the insider term that matters: haircut in repo and collateral lending. A haircut is a safety margin, a just-in-case buffer when things get shaky. A bigger haircut means posting more collateral to borrow the same cash, so the same balance sheet can suddenly fund less, even without new spending. Stress triggers second-order effects. Rules tighten, behavior shifts fast daily. Sometimes the system tightens through plumbing, not through policy speeches. Now, Job 3 debt also helps governments manage uneven cash flows. Tax receipts and spending aren't perfectly timed, so short-term bills smooth gaps. Not drama, big payments run on schedules. So debt manages timing, not just deficits.
Now the question everyone asks, why not print the cash and skip the debt?
Because the system isn't just looking for cash, it's looking for contracts. Printing can create money, but bonds create tradable promises with clear terms. Those promises can be priced, traded, and pledged as building blocks. Cash is fuel, but contracts are the standardized parts that fit the machine. So why isn't pay it off the goal the way it is for households? Because paying it down fast can shrink benchmarks and shrink collateral supply. Take away the yardstick, and the economy argues about what money costs at once. Take away the collateral, and short-term funding has fewer safe anchors. So, the system often prefers managed rollover over sudden disappearance. But none of this means debt has no limits, trade-offs, or real risks. The real constraint is trust. Can the state finance at sustainable rates over time? Trust means repayment stays reliable, and inflation won't quietly shrink what it's worth. When trust is strong, rollover feels boring, like water behind a sealed wall. When trust cracks, debt stops being infrastructure and becomes a stress test. The stress shows up in yields as investors demand more compensation for risk. Higher yields can increase financing costs, tightening budgets by driving up interest expenses. Yields set the baseline, so when they rise, other rates follow, quietly raising bills. And that's why confidence plays as crucial a role as the headline debt total in determining financial stability. The danger isn't debt exists, it's the base layer loses credibility. If you've wondered why auctions matter, it's because they refresh price signals. They're not just funding events, they're maintenance checks for the money pipes.
Quick question. Have rates risen while your paycheck stayed flat?
That disconnect is often the benchmark shifting under the economy's floorboards.
Another question. Who benefits when uncertainty rises across markets?
Often, it's whoever already holds trusted collateral when others scramble for it. That's not a conspiracy. It's incentives reacting to constraints and fear. If the debt disappeared tomorrow, would your life get easier or harder?
Tell me your theory in the comments, and explain what you think would break first.
And if yield, repo, or haircut still feels fuzzy, ask below to clarify. We'll answer the sharpest questions in a follow-up because this topic compounds. Now the reframed government debt is scaffolding for prices, payments, and trust. It anchors the cost of time and supplies the collateral that moves cash around. Change the scaffolding too fast, and the whole structure has to reprice itself. And the open loop is this. What happens when central banks step in and start controlling these flows? Because the next layer is how policy leverages these IOUs to influence and direct the entire financial system.